Yeah. So a very warm good morning to everyone who has already joined us today. This is a webinar again brought to you by ICICI Direct, and the purpose of setting up this exclusive webinar for our audience was that whatever webinars we have been doing in the recent past, and wherever we have been hosting sessions, we've got a lot of questions specific to futures and options on the changes that have happened in the industry in the recent times, starting October 24 till date, and what has been the impact overall on traders. And this is pan industry. So we used to get a lot of questions, and we then thought that we will do this exclusive webinar just covering the changes that have happened recently in the F&O industry. So with that context, let us just start, and I'm just thankful to all of you for joining in. Again, a very warm good morning. Yeah, and with that, so the first point, and we all know, when it comes to futures and options, people love expiry days, right? And there was a time when we had expiry days available to us on each and every day. So this just does a quick recall of the times early October, before October 24, when on NSE, we used to have expiries almost every day. So there was a mid-cap Nifty expiring on a Monday. There was a Fin Nifty expiry on a Tuesday. Bank Nifty is on a Wednesday. Nifty was on Thursday. And similarly on Sensex, we used to have BankX on Monday and Sensex on Friday. So effectively, for all the F&O traders, we used to have an expiry every day, right? But then there was a regulatory intervention that came in, which then asked the exchanges to have limited one expiry per exchange per week, right? And the exchanges had to sort of choose their underlying index contracts on which the expiries could exist. And for all the other derivative underlying contracts, there was an option of month-end expiry, so a monthly expiry. So with that, this is effectively what happened in the industry. As we know, now the Nifty expiries are on Thursday, and that's the only weekly expiry that we have. And on Tuesdays, we have a Sensex expiry. This has happened post 20th of November. So, and what had been the intent of this regulatory intervention was that there was a paper available to everyone in the open domain, where we saw the amount of losses that were happening to F&O traders. Effectively, 9 out of 10 customers who are trading in F&O were in losses, right? So the intent was very simple: to protect the retail investors' interest and to curb excessive speculations in the market, right? So this was one of the interventions that the regulatory did, which restricted then the expiries to one expiry per exchange per week. And all the other expiries like Bank Nifty, Nifty, Fin Nifty, everything else shifted to monthly expiries. So for NSE, the month end Thursday has all other expiries, and for BSE, the last Tuesday of a week have all other derivative contracts expiries, including single stock expiries. So this is the first big change that happened in the month of November, last week of November. Also, there has been a very recent update in the industry where there was uh, uh, a discussion that whether NSE will change its expiry day to Monday or it remains on Thursday. So there have been some recent updates. As of now, the expiries are Tuesday, Sensex is Tuesday and Nifty is Thursday. Now, the second biggest change that happened in the industry was the lot size changes, where every contract got shifted to a higher quantity per lot. So we'll take the most favorite contract, for example, on NSE Nifty 50, which earlier one lot was defined as 25 quantities. It got redefined as 75 quantity. So 75 quantity of Nifty 50 now is one lot. This happened with effect from January 25. Similarly, for Sensex, if 10 quantities were one lot, 20 quantities now became one lot as per the new definition. And it was the same across other contracts like mid cap, Fin Nifty, Bank Nifty, Bank X, right? So what this did was effectively the participants in the market, they had to bring in increased margins to continue trading, right? So if there is a customer who was just simply say buying a call option, he had to bring in X premium effectively, and this we'll cover with examples in the subsequent slide. Effectively, he had to bring close to 3x premium if we are talking of Nifty 50, right? So this directly impacted the participation in the markets, and customers who have capacity of staying in the market remained. A lot of customers who used to just trade on one lot, two lots, some of them got impacted, and they were organically weeded away from the markets. So this is a simple example for all of you, that what is the impact been on option buyers specifically, right? So on my left hand side on the screen, if you see, if there was a option buyer who used to buy one lot, right? And this lot definition is as per the old definition before 20th of November 2024. The lot size was 25. Assuming the premium was 190 or 200 rupees, approximately the trader had to bring in 4,700 rupees as a margin requirement. Now the same individual, if he has to remain in markets with the new definition of lot sizes, which is 75, his effective margin has gone up to 14,000 rupees, right? And this right hand side is just a quick simulation that we have done for, if you see the ATM prices right now, almost half an hour back, it's around 14,000, right? That's the requirement for a 3rd April expiry day. So what you can easily make out of this is, even option buyers where the margin requirements were usually on the lower side, um, even for one lot, buying the margin has become significant now. 14,000 rupees is a significant amount. So you've seen that amounts have gone up. Similarly, let's see what's happened in the life of sellers, right? Yeah, so this is now an option of someone who's selling options in the market. Again, a pre and post is what is visible on the screen. On the left hand side, if you see, if there was an option seller earlier who was writing a 25 quantity or a one lot option at a premium of 100, he used to bring in a margin of 70,000 approximately on the table, right? But post the regulatory changes, now that the lot size is gone to 75, and these all the examples that we are discussing, for convenience, we have just limited it to Nifty, but the impact is same across Sensex and Nifty. So if you see on the right hand side, the same customer now has to, for underwriting one option, writing one option, he has to now bring in approximately 2 lakhs to 2,10,000 of a margin, right? So here also you see an impact of almost 3x. So that's the change on option seller side. Similarly, people who buy or buy futures, the impact has been same, right? Earlier, if the margin requirement was 70,000, it's gone up approximately 3x. Now the requirement is 2,10,000. So broadly, before we move to the next slide, broadly what this tells us is the 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 players who can have a capacity, who have a defined capacity of staying in the market have stayed, and that is what we have also seen. A lot of customers, especially with us, have still stayed because the capacity issues were not there. But in the markets, the long tail, which was there, who are only doing one lot, two lot of buys, option buys, they have sort of seen a stress, and some of those customers have got weeded out from the markets. Yeah. So what we've discussed so far is number of expiry instances in a week, going down from, say, an expiry every day to just two expiries, one to every exchange. And second, we've seen the impact of lot sizes on the contracts, right? Now, this is the other intervention that the regulatory did, which is extreme loss margin, right? So a lot of customers reach out to us on a daily basis saying that, hey, there's a margin requirement that I have. There's a margin that is needed in the system, right? But on expiry days, we get notifications, we get messages, and this is across the industry, where there is an ask of an incremental margin being brought to the table. So why does that happen is what we'll cover in the next maybe 5-10 minutes. So one, there is a measure that regulatory said that on the expiry day, there'll be an incremental ask of 2% of ELM. ELM is extreme loss margin. So what this does was effectively, people thought that it will increase the margin requirements maybe by 2%, but effectively, and we'll explain through an example, effectively on a day, on an expiry day, it actually makes an impact of 20% delta on your margin requirements. So an incremental ask of 2% ELM effectively means almost 20% of margin requirements on expiry day. So let's see this with an example. Uh, so on the left hand side is before change, and this only impacts option sellers. This clause doesn't impact buyers. This only impacts option sellers. So on the left hand side, if you see, if there was an option seller as per the old definition of 25 quantity lot size, and the example is again Nifty in this case, if he was writing a contract, right, the margin that he needed was 73,200, for example, right, on the left hand side, when there was no ELM requirement and the quantity was 25. But after the changes, both the lot size and an incremental 2% being required, right? On the right hand side, if you see, the contract value of a lot size of 75 with a spot price of 25,000 becomes somewhere around 18,75,000. Now, 2% of that contract value, if you see the second last line on the right hand side, is 37,500. So because of the lot size impact from 25 to 75, automatically my margin ask went from say somewhere around 75,000 to 2,40,000, and an incremental 2% TLM on expiry day on the contract value means another incremental 37,500, which basically means that my margin on the expiry day now has 2,71,500, right? So again, just summarizing, while my margin ask as an option seller has gone 3x, but on the day of expiry, I have to bring in another 37,500 at one lot size as part of 2% incremental ELM, which is 20% change in my margin. So this is what an ELM impact has done. And all of these across the industry, you have tools like margin calculators and all, which usually gives you a sense. And most of the tools across the, say, for example, at ICICI, if you come on margin calculator and if you put your positions, you will see what is the margin requirement on any given date vis-a-vis an expiry day, right? So the margin calculators are intelligent and they incorporate this knowledge. But that's the impact of ELM. Now moving on to calendar spreads, right? So a lot of customers who used to have hedged positions and who used to enjoy the benefit of calendar spreads. The regulator came down and said on 10th, effective from 10th of Feb 2025, the calendar spread benefit will also cease to exist, right, on the day of expiry per se. So now this example gives you an insight to how that impacts the customers. So assuming I've got a hedge position and I've got long in Nifty, right? Assuming I've taken a Nifty March future, uh, and I've shorted a Nifty for March, right? So I'm sort of hedged. I used to get a hedged benefit. So if my margin requirement was 2,04,000, 2,04,000 for both these positions, effectively the margin requirement after the hedge benefit was around 1 lakh. This is before the change. It stays, but on the day of expiry now, both the positions will behave as standalone, and I'll have to maintain a margin on the day of expiry for 4,08,000, right? So similar to ELM, this happens only on the expiry day, and it happens for positions where I've done a hedge and I'm trying to benefit from time decay. I've taken a long position and a far short position. Those type of positions will get impacted because of this regulatory intervention, right? We can take another example. So say, for example, for option players, if you have bought a Nifty March call option, and if you've sold an April call option, even in that case, on the day of expiry, the calendar spread benefit will cease to exist. You'll have to bring in those extra margins on the day of expiry. So these are two things where the margin requirements got impacted on expiry days. One alternate intervention that's been happening in the industry, and again, we get a lot of questions from our customers around algo trading, where now SEBI has released official circular on algorithmic trading for retail customers. where in depth they have tried to instruct the brokers and the exchanges to put a SOP in place, a standard operating process in place for algorithmic trading. Now, this is an exciting space where ISEC already has products live on the platforms. But I'll just try to cover the gist of that circular because we usually get a lot of questions on algorithmic trading. So broadly, the paper speaks in details about algorithmic trading in the retail industry. They have defined a few words like API trading, a white box algo, a black box algo. So broadly, a few things that we get as frequently asked questions we'll discuss. I'll just try to cover those. So one is they have acknowledged that there is algo trading which will happen in the retail. The brokers will have to manage the end-to-end process with the exchanges. Every algo trading strategy has to be approved with each of the exchanges. There'll be strategies like white box and black box defined within algo trading. So white box strategy will be a algo where the customer has complete view of what the underlying parameters and variables are. They can set their own variables in the algo and execute the algo. So something that will be a white box algo. A black box algo will be where the research analyst with the broker will have his own algo running. The customer just has to read through what the algo does, and if he can relate to the logics of the algo, and if he's interested, with one click he can enter he can run the algo. There the parameters are not known to the all the parameters are not known to the customer, so there might be predefined parameters within the algo. But having said that, both these processes will have a standard operating process, and you can come on the platform, you can see these algos, and you can execute them at your interest, right? So these are few big changes that happened, and which we used to get a lot of questions. So we thought that we'll cover this in an exclusive session. Yeah. So with that, now we will quickly discuss the tools which uh, traders can use, right, to benefit. And say, for example, on ICICI Direct platform, I'll just bring up my screen. Yeah. So I'll just start with the most basic feature. So when traders come in online, they first come to the platform and they have to bring in funds. They have to allocate funds for, say, F&O trading, right? So a quick demo of that on allocate funds. So this is the screen that you see on ICICI Direct platform. Now, assuming I have to allocate funds for my F&O trading, right? So I'm just saying I'll add, say, 10,000 rupees to my F&O allocation, and I click a submit. Now, if you see, immediately that fund is allocated, right? And in the GFI, I can now start taking positions in the market. What this also gives me is on a real time basis, the funds that are in the bank, which I can allocate to different segments. And if I have to deallocate the funds, the process is as simple. I can just click on reduce, say I want to deallocate 10,000 rupees, and that 10,000 is back in my bank account, right? So just thought of covering quickly that starting usually is an inertia for most of us. But here you can, in a very seamless way, bring in funds and you can start taking positions. Now, coming back to what we discussed. So assuming there are so many things which are happening and I want to see how my margins will behave before taking a position, you can go to smart tools on the ICICI Direct platform and you can go to margin calculator, right? So I'll give a quick demo of how margin calculator behaves. So this is the page. Now I can choose from NSE, BSE. So we'll just for convenience, we'll stick to the Nifty example that we were discussing all this while. So I choose NSE exchange, I choose options. I'm saying I want to go for a call. You can choose call, put whatever stock code will be Nifty. I just type in Nifty and select it from the drop down. And see the expiry day is pre-filled. If you want to change the expiry day, you can. But let's, for this example, leave it to 3rd April. And I want to do one quantity. So I can just with plus minus increase the lot sizes here. But I'll leave it to one lot right now. And the strike price, say 23,600, I want to enter. Now the price has got pre-filled. With one click, you can also see the quote, the get quote here, right? You can see the bids and offer prices. But I'm just staying right now to the example of how do I calculate the margins required on any position that I'm going to take, right? So assuming I'm buying this and I add the position, right? And now, so straight away it shows me what is the, yeah, assuming I'm selling a call, right? Straight away it shows me what is the margin required. So assuming on this position of mine, I need 2,05,000 of a margin. But what if I want to now do I want to take a hedge benefit, and I'm saying at the same strike price, I'm doing a straddle, say for example, and I'll be selling a put option also. So what I now do is I just go select a put, action remains as sell, my strike price remains the same because say for example, I'm doing a straddle, quantity remains the same, and I'll do a add. Now, if you see, uh, for individual legs, the margins are shown on the screen, right? For my put sell, I have to bring in 2 lakh rupees. For my call sell, I have to bring in 2 lakh 5,000 rupees. So in all, I have to bring in 4 lakh 5,000 rupees. But because it's a hedge position on the right hand side, the calculator will show you that actual margin requirement is 2 lakh 42,000. And there's a strategy margin benefit that you are enjoying. So this is a tool that you can use. So given now that so many things are happening on an expiry day, right? How do I know that what is the margin required now on an expiry day? On any other given day, this is the benefit I'm getting. Now what will happen on an expiry day? So, and assuming my positions, and I'll show you that with an example, was also calendar spread. So on expiry day, this tool will behave differently, right? So if I'm taking a spread position, so say for example, I'm just buying a near month contract, right? Yeah, I'll do the fresh. So assuming I'm just buying a near month contract, and I'm shorting a 5 month contract. Right now you can see on the right hand side, right? What has happened is my margin requirement, I'm getting a total margin of only 97,228. And there's a margin benefit of 1,28,000 on this position. But now if I run the same margin calculator on an expiry day, say for example on a Thursday, because it's a nifty contract, the margin benefit that is showing on the tool will cease to exist. So I'll have to bring in the exact 2,25,603 rupees. And this intelligence is pre-built in the calculator, right? So just covering that there is an impact on expiry days, and how do I understand the positions that I'm going to take? What will be the impact? I can very well do analysis of the same on the margin calculator. Yeah. Similarly, a lot of times we get a question that whether we can have a facility where I can check the positions that I'm taking, what will, if I can do a back testing on those positions. So again, on ICICI Direct platform, you can get a tool called Backtester, which is absolutely, it's available to everyone. There's no incremental cost to it. So I'll just show a quick demo maybe on Backtester. So I go to Backtester in Smart Tools on FNO, right? And I have something which is already saved, right? So I have created, if you can see, I've just created a strategy where I'm saying I'm selling a call which is out of the out of the money, and I'm selling a put which is in the money, right? So this is maybe a strategy that I want to run. But now before entering the markets again, I want to see that how the strategy will perform, right? And you can add, delete the legs that you've created in a strategy, right? You can create a new strategy also on this tool, and you can just maybe the intent is to test that how will my strategy perform. So there's a simple option of backtest, and if you can see the parameters, right? So for me, I'm saying I enter the markets at 9:20, I exit the markets at 3 o'clock, right? If I want, I can put a strategy trigger, a stop loss. If I'm trying to put a profit target also to it, and then backtest. All of that is possible. But for the sake of convenience, I'm just saying I've just sold a call, I've sold a put, and now I want to backtest it. So I click on backtest. It asks me for a start date and an end date, right? Assuming I'm saying I'm investing the amount in this strategy, assuming 50 lakhs for the scope of discussion, and then you run it. So this tool will take approximately 45 seconds to 1 minute, and it will then give you an output. And as we discussed, doing this online, it's already running. It will give you an output on how your strategy would have performed from 1st of December to 19th of March with the amount that you have defined. And it will also compare that output against the benchmark. So how the index has moved overall, and how did the strategy moved, and it will show you the returns and the Sharpe ratio and the drawdowns which are required. Also, so while this is happening, you can see there are options of consoles and logs, right? You can take the logs out from the system, review it. There's an option of full back test, right? So you can continue to choose your strategies, modify them, see how they're performing over a year's time, 3 months time, 6 months time, and then take informed decisions. So while this is happening, I think some of the viewers have put in a question. Yeah. So this is one of the most basic and great question that we receive. So someone has asked that what's more dangerous, an algo going rogue or a human making emotional decisions, right? So both are dangerous. If you ask us, both are dangerous. But then the beauty of an algo is that there is no emotion involved, right? There are predefined parameters. The risk that an algo runs is it's a technical tool, right? So there will be performance issues. Sometimes in an algo, the API doesn't fire, right? Or it meets a particular criteria, but the execution time, there's a 200, 300 millisecond of a delay, right? So those are technical risks that are involved, which might happen once in a blue moon, right? But when you are investing on your own and the decisions are more sentiments based, that's the larger risk, right? So, and that is a position that we absolutely want to avoid. And hence we are on this call discussing tools which help you understand what are the margin benefits you can get. How do you plan for your margins? How do you plan for your capital? How do you plan for your strategies? Can you first backtest them, make them full to some extent foolproof? In an informed way, you are entering the markets, right? Seeing the research recommendations will also show that as the last part of the call. We'll show the research recommendations also. What is the view overall? So these are all informed ways of entering, right? And the beauty for algos is also that all these algos have a summary to it. What does the algo do, right? If there's a particular algo which is momentum based, right, it buys positions for you. It's a long only algo. If the markets see a momentum, it can create positions for you, and those positions are hedged in nature. And then over the period of last 2 years, 3 years, right, we yeah, over the period of last 2, 3 years, we've seen that how have algos performed. So that again keeps the customer informed. So to answer your question, yes, getting emotions out is the best thing that you can do, and algos do help there, right? So someone asked to just demo the algo. So a quick demo of a say white box algo that we discuss, a smart trading tool. So if you just click on smart trading, and this is available to all the customers, ICICI customers. Now see, this is where you can define all the parameters that you want. So I'm saying, say there is a 23,600 call, right? Where I want to take a position. I am just keeping it pretty simple. It's a buy position that I want to take. Now I can define all the parameters as a customer on the platform. So my position is this. My basket value, which means the margin that I would bring in, is 11,000, for example. Now, before entering, I'm saying my max loss on this position should be limited to say 2,000 rupees. My max profit in this position should be, say, for example, 6,000 rupees. And I want to ensure that when profit reaches 2,000 rupees, I'm assured of 1,000 rupees, right? So that is how I've defined it. So on this position, when the algo executes this position in the market for me, on this position, my max loss is 2,000, my max profit can go up to 6,000. But then it empowers me that if my profit has reached to 2,000, then at least if the market takes a reverse turn, 1,000 rupees is assured to me because it will exit when it falls back to 1,000. What this also reads is that the profit can be trailing. If I've just highlighted that on the screen, which means that if the profit has reached 2,000, I'm assured of 1,000 rupees of a exit point. But if the market continues to go up towards the 6,000 mark, from 2,000 it's gone to 4,000, my profit will also trail. This 1,000 rupees will then become 2,000. So from 4,000, if it has returned back, if the markets have dropped back, I'll be short of 2,000 rupees. So my profit is also smartly trailing, right? So these are the benefits in an algo, and this is an example of a white box algo where you can define your own parameters. There are, and if you don't want to do this also, you just want something which is a research analyst back on the ICICI Direct platform, you can just go to algorithmic trading Spring. Spring is a product name. And say there is a Nifty long range that we have, right? Or Nifty long only strategy that we have. Now I do a trade here. And see, there is nothing much on the screen. It only says that the minimum capital that has to be deployed is say 1,80,000 is what I need to maintain. And there is a one lot position that I'll take, and all I have to do is press a trade button. So for a customer now, from a retail customer, if I read this and it makes sense to me that whenever the market is having momentum in either of the direction, there is a position taken, there is a stop, then there is a hedged position taken against it, there is a system defined stop loss. So the algo will do all the decisioning for me. It will continue taking positions, exiting positions, depending it's met the profit targets or the stop loss targets. Then there are strategies which I can run at a click, right? So yeah, so that was one of the questions around algo, which we've just taken. And the last thing that we want to cover on this session would be, yeah. So this again is a one-click sort of an entry on strategies where if I have a bullish, bearish, or neutral view on the markets, I can choose a strategy in a click. So these are predefined templates that are available. So if you saw during the start of the call, I took a straddle, right? I just sold a call and a put. Now that can be done at a click also. So I'm just choosing Nifty short straddle. Now it's selling a call, selling a put. It's showing the quantity. It's showing me the LTP against the expiry days, and it also shows me the expiry payoff, right? So in a click, I can understand what is the expiry payoff, what are the positions that are getting created, what is the margin that is required, what are my available limits, and with a click, I can enter into these strategies, right? So yeah, so with that, I think we'll bring an end to the session. So broadly, as a summary, what we covered were what has happened in the market in the last 4-5 months, right? How has it impacted volumes in the market? How a smart trader uh, can preempt the impact of these changes on the margins? How can he backtest his positions, right? And how can he continue to be smartly invested or trading in the markets, right? So yeah, so thank you very much for joining. It's been great. We had some questions, and we'll continue responding to the questions which have been put on the chat. And thank you so much. Have a great day ahead, and we'll continue to do these sessions more. So thank you so much, everyone.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.